Tesla CEO Elon Musk's role in the Trump administration has grown rapidly since the inception of the Department of Government Efficiency. But with Tesla shares having one of the worst weeks since the election, investors are wondering if Musk's role in DOGE is pulling him away from Tesla. For more, we're bringing in Cathie Wood, CEO and CIO of ARK Invest. Cathie, always great to see you. Tesla is still your top holding in your ARK Invest, ARK K, as we like to call it. That's the ticker. And you know, we've got, obviously, Musk very visible in Washington. But not only that, Time Magazine put him on the cover behind Trump's desk as the sort of de facto president, if you will. Now, we have talked before, Cathie, about Musk's multitasking. But this is sort of next level, Cathie, in terms of where he is putting his attention. Is it a concern for you as an investor?
Well, it's interesting. We were on his earnings call last week, and I don't think I've ever heard him more engaged or more into the details, answering in detail analyst questions. So as I've said before, I think he's an amazing CEO in that he is a troubleshooter. He figures out where the pinch points are, the gating factors, and he goes right at them. And I think he's doing it very effectively.
I mean, at the same time, the stock has taken a big hit. I mean, he may be figuring out those points, but at the same time, we got a lot of reports recently about Tesla sales, being down, deliveries being down in places like China and Germany.
Yeah, what's happening is the Model Y, which is the largest selling car in the world, is going through a refresh cycle. And I can tell you personally, I went to buy a Model Y, and at the showroom, they said, no, wait, the whole thing's going to be refreshed. This was several months ago, and lo and behold, this is where we are. So I'm happy they told me that, and I think I understand why we're seeing sales lag here a bit.
So what turns it around, Cathie? What's the catalyst that moves this stock higher?
Yes, a couple of things. I think they're going to come out with their lower cost car this year. And so that will increase access to Tesla's cars. Elon's always talking about affordability, certainly working on that one. And then, of course, autonomous. We do think that Tesla is getting ready to launch its autonomous service. We know they will launch. They announced the launch in June in Austin. And the question then is, how quickly will they roll out to other cities? And we think it will be more quickly than many think.
Another headline that we saw today is that the Trump administration, as predicted or as expected perhaps, is halting the government's $5 billion program to build out a national charging network. Is that a wash for Tesla? Is that a negative for Tesla if people don't have as many places to charge? Does it benefit Tesla because they're building their own network? How do you view that?
Yeah, I think, well, a lot of auto companies have already signed on to Tesla standard. And so why not use the Tesla charging network instead of duplicating expenses with government subsidies on top of that? So I think it will benefit Tesla. I think it will be good for the entire ecosystem.
Cathie, we're making our way through earnings season, that mega AI trade and trend, Cathie. Some names reporting perhaps some disappointment. I'm curious what you've learned this earnings season, looking at those reports, listening to conference calls. Has it changed at all how you want to invest, where you want to put money to work in that AI trade?
Well, as we know, Palantir has been a huge beneficiary of this earnings season. I think many people are beginning to understand that hardware, of course, is important. Cloud is important. But in order to deserve the valuations they're getting, there have to be beneficiaries beyond that. And we think platform as a service is going to take increasing share of the tech stack. And so that does benefit companies like Palantir, GitLab, and others that developers are signing on to.
I'm curious though, Cathie, why, yes, those companies will benefit. I'm curious why you're not in the hyperscalers. So, we've talked before about you not being in NVIDIA. I'm curious why you all have made the choice to go the route that you have with Palantir and the other names you mentioned versus some of the other Magnificent Seven, for example.
I think we are in all of them in various of our portfolios. You're asking about ARKK, the flagship. We do own Amazon. And we do think, after listening to the call last night especially, the cloud is a central part of this story. So love what they're doing there. We were concerned for some time that maybe agentic personal agents were going to disintermediate Amazon on the retail front as our personal agents go shopping around the web for us. But, I do believe that Amazon's got, they said last night, a 14% advantage in terms of lower prices vis-a-vis other online shopping sites on average. So we're less worried about that. And as you know, we post our holdings and trades at the end of every day. So we have been building that one. NVIDIA, we do own in other portfolios. We think there is huge demand going forward. But again, just listening to Amazon's call last night and to others, there's more competition brewing on the chip side of the equation. Amazon has two, Graviton and Trainium and Inferentia. So on the supply side, there is more competition brewing, and we are also seeing with DeepSeek, for example, there is a possibility that more of the large language models are going to be built on high-end workstations, maybe not so much dependent on the cloud. High-end workstations depend on fewer GPUs. All of that said, this is all at the margin. The whole space, we think, is going to be vibrant for years. We are so early in the journey here, and we're pretty excited about it.
On Amazon, though, Cathie, the stock did come under pressure today because AWS sales showed no acceleration. So as a believer, as a shareholder, as a bull, is your bet there, listen, those capacity constraints, they're going to ease and the AI rollout is simply, we're early days still?
Yes. We do believe that the capacity constraints will ease. Amazon said second half of this year. So yes, we do.
How close do you think we are to that agentic AI future that you were just talking about where, I have an agent and I tell it to go buy me something and it just goes and searches the web for that thing?
We think it's going to be here sooner rather than later. In terms of agentic right now, we're seeing coders, for example. Well, AI, large language models, you can give them a coding project and we're seeing that they can accomplish 85% of the task with no human intervention. That's the beginning of agentic, and we think it's going to push into every sector very quickly. AI training costs are dropping 75% per year. AI inference costs, which is what would be used for this personal shopping agent, they're dropping 85 to 95% per year. So the cost of innovation is collapsing, and we think more innovation is going to happen, especially around this agentic AI opportunity.
Cathie, as I always do ahead of us talking, I go and I look at how the various ETFs have been doing, not just ARKK, but the others as well. And I know you like to be judged on a longer time horizon. So I'm looking at 3 years, I'm looking at 5 years, I even looked at 10 years. On all of those metrics, especially the benchmark ETF is lagging the S&P 500. We've talked about this before. What do you tell investors, clients, when they come to you and they say, Cathie, what's going on here? When am I going to be getting these big returns that should be coming from these big innovation plays?
Well, we have just come from facing 3 major headwinds over the last few years that have turned into tailwinds. But before I mention those, I should say over the last 10 years, Morningstar who ranks all ETFs, we are in the top, I think we're in the top 7.5% of their rankings in terms of where they classify us, which is in mid-cap growth, because we do tend to be smaller cap than the broad-based benchmarks. So over a 10-year period, top 10% will take that. That said, these three headwinds, what were they? And they really started after COVID. First was the concentration in the markets towards the Mag 6. I think after the fallout from COVID and the sorting out of the market, people have been scared and saying, they value cash very highly as interest rates went up, and they like to dabble in the larger cap. That's the safer part of the market. So that the broadening out of the market that we are expecting now should really benefit us. So the first headwind was concentration in the markets. The market is beginning to broaden out. We see that since the election. The second headwind, I mentioned it, was interest rates. We went through a shocking increase in interest rates, up 24-fold in little more than a year's time. All long duration assets were plastered by that, including bonds that are supposed to be the safest asset class. They had some of their worst years in history. So concentration, interest rates, and then the last headwind we faced, especially in early 21, as the COVID had bid up our kind of stock to, incredible heights from a valuation point of view. We had to work or grow into that valuation. And in the yen carry trade period last year, so last July, August, what we saw our portfolios based on an adjusted enterprise value to EBITDA ratio drop towards a market multiple. We've worked with S&P to develop this index. So the valuation headwind is gone as well. So concentration, interest rates, valuation have turned from headwinds into tailwinds.
Cathie, always good to see you. We covered a lot of ground in a short amount of time. Appreciate it.
Thank you so much.